Hi, and welcome to the latest episode of our Pensions Age podcast series. I'm Laura Blows, editor of Pensions Age, and today I'll be looking at global equity investment. Joining me to discuss this is Christopher Rossbach, CIO of J. Stern & Co, and also its World Stars Global Equity Strategy Portfolio Manager. Hello, Christopher.
Hi, Laura.
So, Christopher, to begin with, let's set the scene a bit and look at the role of equities broadly within a pension fund portfolio. Long gone are the days of the traditional 60-40 equity bond allocation split, and pension funds investment portfolios are a lot more complex now. So what would you say is the appeal of equity still in a modern pension fund portfolio?
Well, I think we're clearly in an unprecedented situation with the coronavirus. So I think we have to think about how it impacts investment performance, but also people and businesses. So I think it's an important thing to acknowledge that at the outset. But I think that said, equities are absolutely key to generating real pension fund returns and to offset the increase in long-term liabilities that pension funds have. They have a strong track record of delivering 8 to 10% returns or more over decades with moderate risk. And that is because investing in equities is investing in the best of global growth. I think it continues to be the only asset class that is large and liquid enough. It's the only asset class that has the prospect of generating those returns, because bonds, as we know, with the interest rate environment that we're in, are not generating the returns that we need, and I think won't for the foreseeable future. And there's only so much private equity, venture capital, or alternative investment that you can have because of the structural risk, as we saw in the global financial crisis and as we're seeing today. So I think it's important to think about risk and return. There's no return without risk, but I think for long-term investors like pension funds, volatility should be an opportunity and not a risk. We have a 10 to 25-year investment horizon. The Stern family has been investing in equities since the 1940s. And I think the institutional investors and charities for whom we manage assets for have a similarly long-term investment horizon. So I think this opportunity has to be seen within the constraints of the mandates and regulations. It has to be seen within the context of the COVID pandemic and its impact over time. But I think with that kind of long-term perspective, equities offer a significant opportunity for pension funds to achieve their objectives.
Okay, you rightly mentioned the importance of discussing the coronavirus pandemic and its impact on equities right now. So delving into that, would you say that equities are still good value currently with all what's going on at the moment? And if so, is that likely to remain the case? I mean, considering the significant rally that they've had and the fact it's looking likely that we're going to have a sharp recession just around the corner.
Yes, I think it's a function of the global economy. I think it's a function of the companies and their prospects for delivering growth and value over time. And it's a function of the valuations that they're trading at. We are already in a massive recession. It's very clear that GDP for the second quarter is going to be down 25% or more in most major economies. And it's going to take a while for that to recover back to normal. Although I think we're seeing signs that that's taking place, and in particular what's happening in China, I think is giving us an indication that there is going to be a recovery and that we should be constructive about the possibility. But I think if you look at global equities over the longer term, it goes back to the fact that it's companies that drive that kind of growth. And if we can find the right types of companies that allow us to realize the benefits from that, then I think there's every prospect that equities will be able to return to and generate the returns that we're looking for. If you think of that, then global growth at the beginning of the year was good. Interest rates were low and they will continue to be low. And I think right now, looking at valuations is more difficult. At the beginning of the year, they were perfectly adequate and constructive with an outlook of generating 8 to 10% or more over time. And I think now with the impact of earnings that from the recession and the overall epidemic, I think it's more difficult to talk about valuations. So we have to look forward to the end of this year to the next 3 to 5 years, which is a normal corporate investment horizon. And if we look at that, the prospects of the global economy for recovery, the prospects in particular of companies to recover and continue to prosper, then I think there's every reason to believe that valuations are attractive at this point. And therefore, it's a good time to think about investing and expanding the investments in equities.
Okay, I'd be interested to find out more about how the COVID crisis has impacted upon equities in a broader sense as well, not just in the immediate circumstances we find themselves in. For instance, I mean, the common debate in how to invest in equities is the active versus passive debate. Would the impact of COVID perhaps change the nature of that debate? For instance, you know, the criticism people say about active managers rarely adding value, is now a good time to prove actually the value of active investing, for example?
Well, I think that is borne out in, I think it's an important question, because I think it is borne out by the impact that we've seen and the performance that quality managers have been able to deliver. It's at this type of moment when the tide goes out and we see who's swimming naked, as Warren Buffett says. I think what the COVID epidemic is doing is it's accelerating developments and disruptions that are ongoing anyway. So it's accelerating the shift from offline to online. It is showing the extreme need we have for investment in healthcare, both in terms of infrastructure and in terms of services and capabilities. And I think it is accelerating renewables and the conversion from fossil fuels and the increased importance of automation and efficiencies in businesses. So all these aspects are being accelerated by the impact of the COVID epidemic. And so I think that in an environment where the competitive advantage for companies no longer comes from the capital that they invest, but from the intellectual capital that they have. And that competitive advantage is built by OPEX and not by CAPEX. I think that it becomes increasingly important to be investing in the right types of businesses. And so I think that with that kind of differentiation, it's becoming more and more important to select investment. It's an opportunity for active managers to differentiate themselves and to prove that out in the track record. And I think that you see with a number of quality investors, ourselves included, that they have proven themselves in this environment.
Okay, so to continue with you saying how active managers have got an opportunity at the moment, but that is dependent on, as you mentioned, them investing in the right type of businesses. Looking at the quality then of the business they invest in must be an important aspect, of course, of active investing. However, quality is quite a subjective term. What it means to you as a manager might mean something else to another. So perhaps you could clarify what exactly you mean when you talk about quality. What is it to you?
Yes, to us, quality is an absolute gating condition for any investment that we make. So if a company doesn't have the quality that we're looking for in terms of the criteria, then we won't invest and it can be as cheap as it wants. To us, quality are 4 clear criteria. It's a company that is operating in a good and growing industry, that has a strong and sustainable competitive position, that has a management with a track record of value creation, and that very importantly in the environment that we're in, has a balance sheet that is so strong that it can weather any kind of adversity. And so with those 4 criteria, we do a lot of fundamental research to try to identify companies that have those criteria across different industries and businesses. Value to us is being able to generate 8 to 10% or more over time, but it's the insistence on these quality criteria, and in particular, as I said, on the balance sheet, that means that the companies are in a position to prosper and to have the resilience that they can use their competitive advantage, their scale, to reinvest, to make acquisitions and buy other companies in this kind of environment, and to have the stability to be able to care for their employees, to keep their resources going as we're seeing, and to be able to weather the storm, to be able to continue to generate the business and the returns that we're looking for over the long term.
Okay, so you mentioned the sort of value you're looking there is to say 8 to 10% returns over time there. So would you say that quality and value are the most important things that you look for in order to achieve this, to get these long-term equity returns, say over the next 5 years or so?
Yes, I think that the prospects for that are continue to be strong. We have managed money with the quality and value approach since 2012. Since that time, in pounds, we've generated 13.8% on an annualized basis. Over the last 3 years, it's 10.8%. and over the last 5 years, it's 14.3%. And this year, the portfolio as of the 15th of May is up 2.3% in pounds. That compares to an MSCI World that's down 5.9% and a UK all-share index that's down 23. So I think the differentiation is very clear. And I think as we look forward, because of the disruption that I was talking about, where there are industries and companies that are dramatically impacted, I think that the quality and value approach and the need to differentiate and to select investments is of tremendous importance. If you think of the types of businesses that we own, digital transformation is one of the key drivers that we're going to see. We have positions in Amazon and Alphabet since 2012, or in companies like Activision that are in gaming and are, for example, even for my kids in my own house, a tremendous way for them to stay in touch and to be social. Or you've got companies in healthcare and life sciences like Thermo Fisher or Roche or Abbott that are all already contributing dramatically to fighting the coronavirus pandemic and will continue to prosper and will benefit from the business that they have in testing, but will also benefit from the resurgence in elective surgeries, which have been postponed and are clearly one of the big public health issues that we face. Or finally, companies in consumer discretionary like LVMH or Essilor that produce luxury goods or sunglasses that clearly are heavily impacted by what has happened, but have every prospect of recovering, which is again something that we see from mall operators in China and from the results of other companies. So I think that kind of differentiation, I think, is very positive and makes us very optimistic about the ability to generate significant returns going forward.
Okay, so how you look at quality and value there, looking at the long-term feasibility of the companies you invest in and the future prospects is clearly an important aspect of delivering those long-term returns. But there's another type of sustainability as well that has been increasingly important to investors and has risen up their agenda over the past couple of years or so. And that's looking at environmental sustainability of your investments and ESG considerations more broadly. Now, as that had been such an important aspect and a growing one for pension fund investors, do you think, though, that this momentum will continue and it will still be an important aspect? Or may the COVID crisis actually undo a bit of that work and push it a bit more towards the back burner?
I think that it's a critical issue. And for us, the clues in the name, one of our second criteria is companies that have a strong and sustainable competitive position. So for us, the sustainability of what companies do has always been a clear and important criteria for quality. And since we have a 10 to 25-year investment horizon, it is absolutely critical that companies be able to operate in a way that is sustainable, not only in terms of their business, but in the way that they treat their suppliers, their customers, their own employees, and their other stakeholders. And I think the fact that ESG has become an increasing issue, I think, is actually very much in line with a quality and value approach to investing, exactly for that reason. So we have become signatories of the UN PRI and of the UK Stewardship Code because we very firmly believe that the achievement of the UN Sustainable Development Goals is absolutely critical for all of us and part of being responsible investors. And if you think of the businesses that I talked about, whether that's in digital transformation, whether that's in healthcare or life sciences, or whether that's in consumer staples or consumer discretionaries, these are all businesses that are very well placed to operate in an environment in which we place more emphasis on ESG. And I think it's specifically other types of businesses, in particular capital intensive businesses or regulated businesses like utilities, or that are involved in other types of activities like resources that will struggle dramatically. So I think ESG and sustainability is a key issue going forward. And I think quality growth and value investment is an approach in which to identify those companies and be able to invest in ones that are able to grow to generate value, but also to do so in a way that is completely compatible with ESG criteria.
Okay, Christopher, and to bring all that together and to look more broadly to the future there, what is your general outlook for equities across all the major economies and investment markets?
Well, we're very focused on the investing in individual companies. So the views that we have are based on the research that we do, the conversations that we have with companies. And so it's a bottom-up view, not a top-down view of economies or markets. But clearly what we do adds up to a perspective on the overall environment. And I have to say, I continue to be optimistic, in part because I see little point in being anything else, as someone has said in the past. And I think that we are looking at an externality in the COVID epidemic that will happen from time to time. We have to acknowledge that stocks are volatile, but that volatility does not necessarily equate to risk, but to an opportunity. They'll be down 3 to 5% a couple of times each year. They will be down 10 or 15% every couple of years, and they will be down, as they just were, at 25 to 35% or more every 5 to 10 years. That is something that as long-term investors we have to take into account. If we look at the basic fundamentals that were strong at the beginning of the year, that have been impacted by the COVID epidemic, but that are in the process of recovering, then I think that makes me constructive. I think the mechanism of unemployment leading to corporate distress and bankruptcies and leading therefore then to credit issues that could become systemic, I think is an issue. But I think with all the resources that central banks and governments have put in place, I think it is at this point unlikely that it will amount to a financial crisis in the way that we saw in the global financial crisis, or that perhaps was a concern in March. I think instead it's going to be a tightrope walk. It's going to depend on the disease. It's going to depend on whether the measures that we are taking in place are able to contain it, whether the testing and tracking that is provided by companies like Thermo Fisher, like Roche and Abbott is successful, and whether we can then get therapeutics and then hopefully potentially eventually a vaccine. But I think as we get used to this environment and as we resume the normal activities that we have, and in particular as shifts take place, like we were talking about, from offline to online and other types of activities, I think the basic prospects for global growth continue to be positive. I think therefore the prospects for companies that contributed to that global growth are positive. And so I think it's entirely compatible with an environment in which we can generate 8 to 10% returns over the long term, and where I think from the current levels of activity and the current levels of valuation, I think we also should be very constructive about markets and about the opportunities that they hold.
Well, I think that's quite a positive note to end on there, Christopher. Thank you very much.
Thank you.
And thank you all for listening. Goodbye.